Hello, dear viewers. My name is Brecht Arnaert, and today I will be talking to Mr. Dimitri Speck. Mr. Speck is the author of a book called The Gold Cartel, Government Intervention on Gold, the Mega Bubble in Paper, and What This Means for Your Future. Tomorrow he will deliver a talk on the future of gold, but today he will give a short preview of that talk. Hello, Mr. Speck. Great to have you.
Thank you very much for inviting me.
In recent years, it has become obvious that, like any market, the gold market is also heavily manipulated. Could you explain to the viewers in short terms how this manipulation takes place?
The manipulation, the systematic manipulation of the gold price started on August 5th, 1993 already, when the Federal Reserve Bank, together with other Western Central Bank, decided at that time not to let the price of gold stay above $400 per ounce at that time. The goal at that time was to prevent the inflation to rise. So the inflation expectation should be kept down through the gold suppression. This was the initial reason for the systematic gold price suppression. And through times, of course, everything changed. The motivation changed, the price changed. It went down first to 250, and then it started rising in 2001. But despite that, also when the gold price was rising, there were periods with strong suppression of the gold price. Yeah. So
even during the rise.
Also during the rise, yes. Yeah. Mm-hmm. The thing was that the central banks initially kept the price down through two main means. One was physical supply through gold selling and through gold leasing. And the second was selling through the future markets. Yes. Yeah, these are price shocks. They sell in a short period of time a lot of gold through the future market. And through that, they cause other investors not to invest in the gold market or to exit even the gold market. Mm-hmm. And this has changed. Now there is only one mean remaining. The selling of gold and the leasing of gold, there is no physical supply coming from the Western central banks anymore. And so they couldn't keep the price at that low level without physical supply. And this is the first very good news also for the future gold price, mm-hmm. to put it simply. From the side of central banks, you cannot expect that there will be big physical supply. It's even very opposite. Central banks are starting to buy gold. And so from this side, the gold price suppression has no bad influence anymore on the gold price. Yeah? But from the other side, these price shocks, as I say, through the future market, they continue and they can come at any time. Mm. Yeah?
As I understand it, you have the London Bullion Market Association, where the price is fixed 2 times a day. Yeah. And the futures market in gold is really only something that developed during the 90s, if I'm correct.
No, it started earlier.
It started earlier?
Yeah.
When did it start?
It started in the 80s, but at least in 1993 on the August 5th, mm-hmm. Yeah, when this
very specific date.
When the gold price suppression started, mm-hmm. the systematic one. There were also some examples earlier, but since then it's systematically done. And at that time there was already a future market.
Yes, yeah. But was it as developed as it is today?
Of course.
Yes.
The gold, I think even in the 70s it might have started the future market, because before there was no need, because the price was kept, and then it was started in the 70s. Yeah, the gold future market.
I want to test a theory that I heard just recently, and that was that if you look at the crisis of 1987. You have a drop in the Dow, mm-hmm. but you have gold rising, I think, about 24.8% mm-hmm. or 25%. Mm-hmm. If you look at the crisis in 2008, mm-hmm. gold also dropped 35%. Mm-hmm. And the big difference would be mm-hmm. that in the futures market, when you have paper gold mm-hmm. joining the fray, then you are commoditizing gold and it follows the same pattern as any resource. While in the old days that was not the case. So the idea behind this theory would be that London Bullion Market Association sold out their gold so that the futures market could get a bigger hold on the price setting. Why? Because if you do that, most futures are bought with debt. So actually you make gold subservient to debt. Do you understand the theory, or could you comment on that?
As far as I understand, I would like to concentrate on really two means, because there are many rumors about the LBMA and so on, that there is a big paper market and. In the end, we have a physical market and we have a second market. Yeah?
Futures market.
Yeah.
Okay.
And these future markets can influence the price. For instance, you mentioned the LBMA. And I want to add here the fixing of the gold price, where I was the very first one in 2001, I think, who did the statistic that the gold fixing is manipulated down. Yeah, and here you can clearly see a pattern. Same happened, by the way, to the silver fixing and to platinum fixing. So we have, the fixing is a big market, big physical market also. And through selling the futures at that very moment, or let's say 1 minute before, and during the period, all this physical prices also drops at that time, how the fixing was organized.
And the central point of this theory would be that the futures market is ruled by debt, because most people buy these futures on margin.
Yeah, but this is, of course, but the idea is finally that with the future market, you can more easily create this price shocks, and the manipulation works over these price shocks. It doesn't. It would also work when there were no future markets at all.
Okay.
Yeah, if you look, for instance, the instance when Cyprus in April 2013, if I'm correct, there was this the top of the Cyprus crisis. The people recognized Europe-wide that the bank accounts can be haircutted. This was a new invented name. So usually there is a bank run following. And at that very moment, the price of gold lost $200-300. And even starting in Australia in the very early hours when there is no trading. So the idea is with these price shocks that the investors have the feeling gold is a bad investment. Okay. I can also keep the money in the bank account.
Yeah. They don't want a correlation between bad economic news. Sorry. They don't want a correlation between bad economic news and the gold price rising.
Yeah, or bad financial news at all. This is the key thing. Okay. And so the key thing is the price must drop. And this is in gold different than, for instance, in, let's say, crude oil or so. If you would make the same with crude oil, it's over sales of futures causing the price to drop, or with corn or wheat or whatever, you would cause more demand. Yes. The people, the gasoline would be cheaper, the people would drive more, and they would have medium and long term the very opposite effect. So in the consumption goods, in normal commodities, you cannot manipulate the price through the future markets longer than maybe a few months. In gold, you can do it. You can do it for maybe a few years even.
Because
exactly. So as soon as the gold price drops, there are investors saying, okay, I leave the market, and others are saying, okay, I don't invest. This is a thing. So we have two manipulation kinds of methods of manipulations. The first mean is the physical supply, which through central bank is history. And the second is this price shock, which can come again. But it's also, I think, less important and will not be as stable anymore. This is another reason. finally, you must look at the asset classes.
Okay.
Yeah, gold typically rises when the normal credit-based money, or when credit and savings in banks are at risk, either through bank runs, bankruptcies. Yeah, this is a more deflationary scenario, or in modern times since the 1930s, mainly through inflation, or through negative real rates, meaning that the inflation is as high as interest rates or even higher. In this period, gold typically rises. Now, this was in the 70s the case, and it was after 2001 the case. Yeah, and if there is another asset class like stocks who is rising also, yeah, it can be that even during this period of times, gold drops. We had this in the mid-70s when gold dropped from around 200 to 100 before it rise again to 850 or so. And we had it since 2011, yeah, when gold did drop from about 2,000 to 1,000, roundabout. Yeah? Yeah, and this was possible only because the stock market did rise. Yes. So in this total picture, you have low real rates or negative real rates, which usually shift the money to gold, except there is another asset class like stocks, or mainly stocks, which are rising in price. Yeah, and so the suppression of the gold price in 2013 in Cyprus could be so long-lasting only because there was also the second effect, the rising stock market. Okay. Otherwise, it would not have happened. Yeah?
And now we are going to a bear market in stocks. Maybe the opinions are divided, and I'm trying to think ahead of what you're saying. So then we should conclude that gold is going to rise as an alternative.
We have now a situation, especially in US, where the stock market capitalization is almost as high as, or practically as high as it was in the very top of the tech bubble in 2000, around 150% compared to GDP. Yeah, so we are in the bubble in the US. Yeah, we have last Friday. Yeah, we have for the first time that the inversion of the yields. Yeah. Yeah. We have the central banks who tried a little bit to.
Now it has been reverted as well.
Yeah, but this does not matter anymore. As soon as we have a bear market, which in my opinion we have since more than 1 year, to lower the rates does not keep the stocks, avoid the stocks from falling. They lowered the rates also after 2000. They lowered the rates also in 2008, and the stocks did continue to drop. Yeah, of course, the low rates was the main reason that the stocks did rise so far. But low rates are not a guarantee that they continue to rise. Yeah, look, for instance, also in Japan, where we have low rates since the mid-90s, and we are still in a bear market far below the late 80s. Yes. I mean, this is decades ago.
Yes. Yeah? So, to summarize, your opinion is then that a perfect storm for gold is brewing. Because all the macroeconomic factors are directing towards gold as a safe alternative.
If we put one piece of the puzzle, then yeah. And this piece is we are over-indebted worldwide. Currently, the financial system in US, in Europe, in Japan, in China has a lot of debt. A lot. And debt and savings, the amount is the same. It's at least 2 times higher than it was, for instance, in the 60s. Round about 250% savings or debt we have compared to GDP. Yeah, and from this it follows that this debt the economy cannot grow out of this debt. So there will be a kind of debt cut. Yeah, in my opinion, through inflation and through ongoing low or negative real rates. Yeah, this is my thesis. But even if I'm wrong, the savings will be cut at least by 50%. And this is generally positive for any asset class which will not be hurt by this.
And what is the risk that the gold manipulation, which has been performed in the past, the example of Cyprus is a very good example, what is the risk that when people will try to run to gold, of course the central banking system also knows that people would like to buy gold, that even during a crash or a heavy correction, that they will keep the gold price down?
They will try most probably again like they tried in Cyprus, but if the stocks are not rising anymore, and in my opinion, due to this high valuation in US, there will be not 5 or 10 years more bull market. It's, in my opinion, without hyperinflation or at least strong inflation, impossible that the stocks are rising that far. That means this manipulation through the futures market will not be long lasting. Yeah?
But now we see that Powell has announced, or that as at least what they are interpreting, that there will be only one more hike this year, and next year no hikes. Or
you can reduce it to zero. This will give the stocks a small push or a big push, like it did already from December 24. The market is already anticipating that the central banking are turning their
So that's already discounted into the price of the stocks.
And as I showed you the examples, the beer market after 2000 and 2008, also there we have seen rate cuts from key rates, and the stocks did drop also. This does not interrupt a beer market.
Another question. I'm playing the devil's advocate here. There's another speaker, Mr. Dimitri Speck, which is the first speaker tomorrow, who says that one of the best investments you can have for the future is actually not gold. And it's a very contrarian idea, at least within the gold buck community, and that would be to invest in 30-year treasuries. Why? Because when an economic recession hits, capital flees to the long run. So he thinks that interest rates on the 30-year bond will go down, treasury will go down, and of course on the surplus value will make a lot of money. Could you comment on that idea?
This might be short term. We already see the yields dropping, but medium and long term, we already have a high deficit in US. We have central banks loaded through QE with asset balance sheet exploded. We have a US especially which has a lot of foreign debtors, maybe central banks. So in the interest in US, if there is really a strong recession or crisis, is to get rid of the debt through devaluation of the dollar and of more inflation. This is core interest. I mean they.
So, but if that is true, then the stock market would react to that as well. If more money is printed, then you could see stocks rising.
No. In inflation, we have typically in real terms dropping stock prices. You could see it easily. In the situation in the 70s in US, you could see it in Germany because before the hyperinflation started, there was also a significant drop in stocks and. So there are also some reasons behind this, that in inflation periods, the stocks are in real terms falling.
A practical question, how much gold would you advise to have in your portfolio as a private retail investor?
In my opinion, you could go for 25%.
So that's a quarter of your assets that you pull out of the system, let's say.
No, it's in the system. It will go back to the system also. I mean, it's not bad for the economy. I mean, mankind lives with gold money and silver money for over many centuries.
I just meant that you limit your counterparty risk on that account. If you leave it in the bank, Cyprus scenario could come about next week. So if you put 25% in gold, at least you don't have that counterparty risk.
Of course. I mean, this is a feature of gold. You don't have the counterparty risk. That's the first. So if a bank goes bankrupt, you are not It cannot be inflated. The central banks cannot print gold. It's difficult to get it out of ground.
Maybe with 3D printers that they will try to...
This is from medieval times and longer that they try to copy gold. This will not happen. And the third is it's independent from states. It's also a very important issue because, for instance, thinking about Russia, they are investing in gold and they are selling their US dollar, the central bank system in Russia. And I don't know, of course, the real reasons, because I haven't talked with them. But most probably they think also if they invest in treasury bills, the US can always say, okay, I make a sanction. I don't, you are a bad guy. You don't follow what I'm doing. I want that you do. And so your bills are currently worthless, or and this is an advantage for gold as well, especially in the central bank system. And foreign policy, in my opinion, becomes a little bit more difficult. We have more tensions within Europe. Italy has another interest than France, than UK, than Germany. And in the past, it was covered down, and this comes out. Also, US is fighting against China, also a little bit against Germany, and so on, and Russia. And this typically leads to gold. I mean, if you can trust your counterparty, also because of political reasons, then you have one more motivation to buy gold.
Can I just go back to the futures market again? I'm fascinated by the fact that the futures originally came from agriculture. You sow your wheat in March and you sell it for the price in August. Now with gold, you see that there are cash settlement clauses where not even the gold has to be delivered. So I see this as fractional reserve trading.
No, it's just another method, in my opinion, because if you're in the gold future long, you don't necessarily need to buy gold. It's the same also, by the way, in the agriculture markets. If you are a farmer, let's say somewhere in western US, and you hedge your wheat, and then the harvest comes, you sell. Or you buy, you close the contract. You don't deliver it in Chicago. This is just the system, how it works.
Our analysts like Kyle Bass, who said, well, give me the physical delivery.
You can do so. You can ask so from CME. Or you can take the cash and buy gold. I mean, the gold is available. It's not so that it's not there. But you can buy gold, physical gold.
Would that not be a factor depressing the gold price because there are contracts that do not even deliver the gold that has
no, this has no influence. What is true in this regard is, but this can also be done with any contract where there is physical delivery. If there is a huge problem that there is not enough gold, if there would be this problem, but it is not there, then the stock market, the futures exchange can always say, okay, we close the contract through money delivery. This already happened in some future markets in the past. Generally, this can, of course, also happen with gold at one point of time. So futures are not as safe as investment than physical gold.
Of course.
So the base investment in gold should be physical. This is, in my opinion, clear. And not somewhere abroad or in the future markets or in certificates or blah blah.
Okay. What will you put your focus on tomorrow in your presentation?
My presentation is about the bubble which we are, and which is the biggest bubble in history of mankind, in my opinion. And that the outcome of when this bubble bursts, and it will burst, and it might burst in the coming years, it looks to me like this, will be difficult for the whole economy of this planet. And this year, this results, of course, in a perspective of a more rising gold price, maybe much more rising.
Any price you want to put on it? I will ask you one of two things, a price or a time. Both together, that's not wise to do so. But.
If I look at the 70s, And I compare the current bull market somehow with the 70s. In the 70s, the price did rise from below 40 to, no, this was already late 60s, yes, to close to 200, then it dropped to 100, and then to 815. Mm-hmm. It did it quite quick. Now the market did rise, did need 2.5 times longer, from 250 to 2,000. Mm-hmm. Then it dropped to 1,000 about. And in my opinion, it will go up again. Like it did in the 70s, it will also need much longer. Yeah, like the first leg of this horse, bull market will need longer. And then the goal is, of course, would be 8,500, but the financial situation is worse than in the 70s. Yeah. If you look, the deficits and inflation rates at that time were higher, but if you look in indebtedness of the world, mm-hmm, the situation is much worse. Yeah. And in my opinion, we have also more possible demand after gold, because indebtedness, as we said, is also savings. So there can come much more money into gold. Mm-hmm. So looking at this, we are above 10,000.
Okay.
But not tomorrow. It will really several years. Yeah.
Good. Good conversation. Thank you for your time, and I'm looking forward to your presentation tomorrow.
Thank you very much from me as well.